Jalinski is the president of Wealth Quarterback LLC, a registered investment advisory firm located in New Jersey. Registration is not an endorsement of the firm or its representatives by securities regulators, nor is it an indication that the advisor has attained a particular level of skill or ability. Investment advisory services may only be provided to clients in jurisdictions in which the firm and its representatives are appropriately registered or exempt from registration. You should not assume that any discussion or information contained in this broadcast serves as the receipt of or as a substitute for personalized investment advice from the advisor. Different types of investments involve varying degrees of risk, and there can be no assurance that the future performance of any specific investment strategy, or product, or any non-investment related content made reference to directly or indirectly in this broadcast will be profitable, equal any corresponding indicated historical performance level or levels, be suitable for your portfolio or individual situation, or prove successful. Past performance is not indicative of future results. Investment advisory services offered through Wealth Quarterback LLC. Tired of losing money in the stock market roller coaster? Frustrated with the government taxing you into oblivion? Worried about inflation? How do you prepare for so many financial uncertainties? Welcome to the show that will help you develop your game plan. The Financial Quarterback with Josh Jalinski. Josh is a noted financial advisor and president of the Jalinski Advisory Group, and he's here to answer your questions. Call into the show at 800-321-0710. 800-321-0710. Now, let's kick off your financial future. Here's Josh Jalinski.
Good morning, America. This is Ernesto Caleri. I am Josh Jalinski's wingman, and you're listening to the Financial Quarterback Radio Show. This is the must-listen-to show for all things money, from tax savings, wealth management, retirement planning, and we also offer a little relevant dose of politics just to keep it real. This morning, our special guest is Jeff Schnepper. He is a tax expert and author of several books on finance and taxation, including the book How to Pay Zero Estate Taxes, and all 28 previous versions of How to Pay Zero Taxes. Good morning, Jeff.
Good morning. How are you this morning?
We're doing fantastic. Why don't you give us a little bit more about your background? You've also done some work with MSN Money.
A little correction. First, the How to Pay Zero Taxes book was in its 37th edition. I was formerly a college professor. I headed up the accounting program at Rutgers in New Brunswick at one point. I set up the accounting program for the State University of New York outside of Rochester in a town called Geneseo. I spent many years at the American College in Bryn Mawr as professor of accounting, finance, and taxation. Subsequent to that, I spent 16 years as Microsoft's tax expert, MSN tax expert. So anytime you went to MSN and went to their homepage, my picture popped up.
Fantastic. Well, good morning, everybody. This is Josh. Josh Jalinski, the Financial Quarterback, with Jeff Schnepper, who wrote an amazing book, How to Pay Zero Taxes. Now, do you have the new edition out for 2021? Jeff?
Josh, I'm going to make my publisher very, very unhappy. My publisher 2 years ago decided to go in the 37th edition to a 2-year book.
Okay.
Well, Josh, with all due respect, I try to explain it to them. The second year, the book is out of date. So as much as I appreciate your aid with the marketing, I would not buy the book
2020.
At this point in time in order to prepare current taxes, because the book is 2 years old and we've had multiple tax changes since. So let's get it right rather than just selling books.
So what updates since the last time you were on? And I remember you were promoting your book last time. What updates do you have for our listeners? What should they be?
We've had multiple changes in the tax law. We've had major tax law changes in about 57 of the last 60 years. Just absolutely incredible. People find it almost impossible to keep up. We've had changes just this year, with the American Rescue Plan. We've had changes to the child tax credit. We've had changes to the dependent care credit. We've had changes to the earned income credit. And in front of Congress today, we have another proposal by President Biden to change our tax laws again.
Wow. So what do you think? So what do our listeners need to know right now, and viewers on the YouTube channel? Give me one.
Proposal already passed. Which one do you want? The big proposal now is to increase the maximum tax rate from 37% to 39.6%.
I mean, but has that passed yet?
That's going to pass. Another big proposal today that has not passed. That has not passed. That's part of what President Biden has proposed and what's being debated right now. They're also debating corporate taxes. The corporate tax rate went from 28% down to 21%. He wants to bring it back up to 28%. I suspect there's going to be a compromise somewhere there around 25%. But these are proposals that are being debated in Congress right now. With respect to the stock market, the thing that your wealthy listeners should really be aware of is the fact that one of the proposals is to tax capital gains when you have income, adjusted gross income of over $1 million. Any capital gains in excess of that would be taxed at ordinary income rates. And again, these are proposals. These have not been.
So the 20% move on capital gains to 39.6%, that's a proposal. The marginal income tax bracket raising from 37 to 39.6 I don't think that's been signed into law yet. I mean, has it passed the House?
Yeah. All of the stuff that I've discussed are proposals. These are proposals. Nothing has been passed yet. Okay? Clearly, they'll have no problem passing the House because of the heavy Democratic majority. The question is whether or not they'll get through the Senate. And that's the real issue.
So what can we do today?
As I said, I suspect the increase in the...
So what can we do today to take advantage of the Trump tax cuts before they are done away with?
Well, the big thing that I would do today is implement some of the estate planning cuts that may go away. Right now, for this year, you've got an estate planning exclusion of $11.7 million. They're talking about knocking that down to $5.6 million. I've heard people talk about knocking it down to $3.5 million. If you have the opportunity to do some planning and do some wealth transferring through either a family limited partnership where you transfer the legal ownership of the preferred shares to your children while retaining the general partnership shares, I think that's a great idea to use the credit today. The IRS has come up with a statement that says that if the credit is reduced, they will not recapture credit that has already been used. So if you use, just as an example, the full $11.7 million this year, if they drop it down to $5 million, you don't have to recapture the difference.
Okay, so if you want to make gifts, you want to do estate planning, you should do that right away. Now, they're talking about raising capital gains taxes from 20 to 39.6 for those above $1 million. What about those under $1 million? I mean, I've also heard over 400,000. They'll raise capital gains taxes on those? What happens there?
Now, let's make sure that everybody understands what the proposal says. The proposal says that if you have income of over $1 million, the capital gains in excess of the $1 million will be taxed at 39.6%. Assuming that they raise it from 37 to 39.6, which I suspect that they will. Let me give you an example. Let's say you have $900,000 worth of earned income and $200,000 worth of long-term capital gains. $100,000 of those long-term capital gains will be taxed at the lower rate. $100,000 of those capital gains will be taxed at ordinary income rates. That's the 39.6. So it's only the excess over the $1 million that's going to be hit with this change in the rates.
But isn't it really going towards equating?
If your income is under,
isn't it really equating going towards income taxes being equated with capital gains? So in the next bill, we're not getting enough revenue. So if you're in a 30% tax bracket or 24, your capital gains rate's going to be 24. Plus you got state income taxes. Plus you have the net investment tax of 3.8. So it could be very considerable.
It could be horrible if they do it, but that's not what they're proposing. Again, remember, it's only the excess over $1 million. So you're not going to be in the 24% bracket. You're not going to be in the 10, 12% bracket. You're going to be in the top bracket because if you've got income over $1 million, that's what's going to put you over there. If your income is under $1 million, this is not going to affect you at all. Not at all.
Well, that's what they said.
You mentioned the increase in...
that's what they said about the Obamacare net investment income tax, the 3.8%. Oh, it wouldn't affect everybody. Now it affects a great deal of people. And then President Trump didn't do away with it, so we still have the 3.8% surtax.
Absolutely, but it has not changed. If on a joint return, you have to, in order to be subject to it, you have to be making over $250,000. On an individual, you have to be making over $200,000. Before that, 3.8 is.
Yeah, but that's my point. That's 200 and 250, not $1 million.
It's not getting the guy in the.
Yeah, I think it's like Pandora's box.
You're absolutely correct. Absolutely correct.
So once the new tax law goes into effect, those investors.
I can't argue with that.
Once the tax law goes into effect, those investors who make more than $1 million through income or sale of their investment, including companies now, will be taxed at that rate as well. How might one structure their business to protect themselves from that? Are there any strategies? Because this could affect the family farm, the family business, all that.
Well, to the extent that you can keep your income under $1 million, that would avoid the problem. Techniques for doing that include using an installment sale if you can. If you're selling property, use an installment sale. Recognize the gain over a period of years rather than all at once, which would raise your income.
No, well, thank you. Jeff Schnepper, How to Pay Zero Taxes is his book. Your website for people who want to learn more about what you do, Jeff?
Just Google me and just Google Jeff Schnepper and you'll get.
Okay, epdy.com. Thanks for joining us, Jeff Schnepper. This is Josh Jalinski, the financial quarterback. Don't touch that dial. Are you
worried about the recent coronavirus crisis and how it may have affected your money? Hi, everybody. I'm Josh Jalinski, the financial quarterback, inviting you to join me for my complimentary 6 Ways to Keep Calm During Turbulent Markets webinar. If you schedule and keep your no-obligation webinar today at 888-988-JOSH. It's a great thing to do if you're stuck at home under stay-at-home orders. Call us right now, 888-988-JOSH. If you're bored, there's never been a better time to get a second opinion on your wealth than right now. 888-988-JOSH, 888-988-5674. And go to my website, retirementrealitycheck.com today and take your free investment profile quiz. And when you buy my book, you're eligible for 3 free gifts. 888-988-JOSH.
Call Josh Jalinski, host of the popular Financial Quarterback radio program, 888-988-JOSH. It's always on your mind. Retirement. Whether you're 55,
back in 50 seconds.
55. Not everyone wants to work forever, and most would like a comfortable retirement. You may already have a plan, but is it the right one? Josh Jalinski, host of the popular Financial Quarterback radio program, is ready to guide you towards financial freedom. He challenges the ways your parents and grandparents saved money with fresh strategies, which are exactly what you need to navigate today's volatile economic climate. Josh's new book, Retirement Reality Check, is available to order on Amazon. It's an easy read that guides you through his system for securing your financial freedom, including tax-saving strategies, understanding the right investment mix, and more. Order now. Retirement Reality Check. Call Josh at 888-988-JOSH. Let Josh help you map out your retirement using fresh strategies. Call 888-988-5674. That's 888-988-5674.
Okay, we're back with Jeff Schnepper of EPDY.com. So, Jeff, what's the best advice you can give small business owners today in preparation?
Best advice I can give anybody, keep records. Keep records. Make sure you have substantiation. The biggest problem I've had with my clients, which are a lot of small businessmen, is they don't have the appropriate records to back up their deductions. Look at those pieces of paper. I want you to think of them as dollars in your pocket. I want you to look at them and think dead presidents, because the money in your pocket, if you've got the receipt, you've got the deduction. If you don't have the receipt, you've got an audit issue. So the best advice I can give to anybody is substantiate, substantiate, substantiate.
And then what other tax tips or things are you telling your business owner friends, clients, family?
Well, you've got a great opportunity this year with the deduction for meals. It used to be that you were able to deduct 50% of your meals and entertainment, your business meals and business entertainment. A couple of years ago, Congress ended the deduction for business entertainment, but you still had 50% for business meals. For this year only, for 2021, you can deduct 100% of your business meals as an expense. There is no reduction there. You get the whole thing as a deduction. The whole idea is to get people to go out and support the restaurants in their localities, and in order to do that, they get the full deduction. So that's something new this year, and that's something that people should be aware of.
So get the meal deduction. What about the earned? You were talking about things with the earned income tax credit. And any of the COVID relief type things that people could take advantage of?
Basically, they're making it easier for people to qualify for all kinds of credits. Just as an example, it used to be for the child independent care credit, the maximum amount of expenses that were able to be counted was $3,000 per child, or $3,000 for disabled dependent. times 2 if you have 2 kids, with a maximum of $6,000 and a maximum rate of the credit of 35% of that $6,000. The new rule is you can go up to $8,000 per child or per dependent, and up to 2 dependents, that's $16,000, and they raised the rate to 50%. So if you've got 2 kids and you're spending $16,000, you get $8,000 as a credit right off of your taxes. And it's refundable this year, too.
So break that down. How does that work? It's a little confusing to me.
Well, okay. Let's say I have 2 kids under the age of 13 who need daycare. And it cost me $8,000 per child for daycare. That's $16,000 that I have spent for daycare. Assuming that I have at least $16,000 worth of income, and that my spouse has at least $16,000 of income, or my spouse is going to school, or my spouse is disabled. But assuming that that $16,000 is your base number, you can now get a credit of up to 50% of that amount, which is $8,000. That $8,000 credit is an offset to your income tax. If I had an income tax that was $12,000 based upon my income, I now only have to pay $4,000. If I had an income tax of $4,000 and I have an $8,000 credit, the IRS this year will be sending me the difference as a check.
Oh, wow.
$4,000 in my pocket.
No, that's fantastic. Are you familiar with... Go ahead.
I'm sorry. I'm sorry.
You go ahead.
No, I was going to say that the Biden administration is extremely family friendly. They as I just discussed, they upped the credit for dependent care. They upped the child credit. We can now get for kids under the age of 6, a credit of $3,600. If the child's over 6 or over, it's $3,000 instead of the $2,000 that we had before. Very, very family friendly, very child friendly.
How many kids are you maxed out at? How many kids are you maxed out at?
On the child credit, there is no max out on the child.
So you could have 7 kids and get how many?
There's an income max, but there is.
What's the income threshold?
7 kids. If I have 7 kids, if I have 7 kids, it's age 6 or over. That's 7 times $3,000 or $21,000 that the IRS is giving you.
And is that
if I have 7 kids? Go ahead. If I have 7 kids under the age of 6, I now have $3,600 times 7 as a credit.
But you have to make under what?
$25,200. I'm under $400,000.
Okay. So yeah, that's a powerful tax credit. If you have 2 kids, 3 kids, 4, 5, 6, even 7. That'd be great. But you got to make under $400,000. But you got to make under $400,000.
Round numbers, yes. And I told my, it starts to phase out. I told my wife, I said, get out there and get me some more kids. And her response to me was, well, if you want them before the end of the year, you're going to have to put more men on the job.
Yeah, well, $3,000, that's a great one. Well, $3,000, $3,000's not going to, it'll help you a little bit, but kids are more expensive than that for sure. So what about the employee retirement, the employee retention credits? What's going on with that? That's also something confusing that you hear about. The ERTC.
That's extremely confusing, extremely complicated. Basically, it's a credit to the employer for retaining employees. And there's a complicated formula to compute the credit, but basically the bottom line is that if you're retaining your employees, it's an incentive to keep your employees on the books, keep paying them, and keep them working, and give you some money in order to help pay them.
Are there any income thresholds or anything like that?
Not for the employee credit, no.
Okay.
That's a whole different kind of issue. It's not so much a deduction as it is an incentive for employers to keep their employees working.
No, fantastic.
Again, the Biden.
So talk to your accountant on the ERTC, and you were saying, I interjected. Go ahead.
No, I was saying that the current administration has done a whole lot to put money in the pockets of people who have been hurt by COVID, who have been put out of work by COVID. It's a huge reaction to try and increase the liquidity out there, get people dollars in their pockets so they can pay their bills. And when they pay their bills, they buy stuff. And when they buy stuff, people make money selling stuff.
No,
fantastic. And when people make money selling stuff, they pay taxes on it.
No, fantastic. And as we round out the interview, any final tips for our listeners? And you write, is this still your website, epdy.com/Schnepper's Corner? Is that where people can find what you do? Is that a good place to send them?
I don't. If people want to find me, just Google Jeff Schnepper. As a final thing, I would like to say something. Our government is constantly fighting, demonize. Each side keeps demonizing the other side. Rather than do that, why not work together? Let me give you an example. And instead of increasing the tax from a maximum from 37 to 39 points percent, just to hit the quote the wealthy, why not really help the poor? And as my suggestion to do that would be to eliminate the payroll taxes, the Social Security and the Medicare taxes for the first $30,000 that people earn. That would give them an immediate tax savings. If you're self-employed, of 15.3%. If you're an employee, it puts 7.65% right in your pocket. That's an immediate tax savings. In order to offset that, we might incur a donut hole and then say, and I'm making up a number, all income over $500,000 is now subject to Social Security and Medicare taxes.
Could Google him, Jeff Schnepper,
to help decrease our inequality.
Jeff Schnepper, SCHNEPPER, Jeff Schnepper. You could Google him, get his book, How to Pay Zero Taxes, 2020 to 2021. And we'll be back after this with your calls at 800-321-0710. Thanks for joining us, Jeff. 800-321-0710. We'll be back after these messages with your calls all hour. 800-321-0710. We'll be back after this.
Hey, meet you out on the first tee?
Yeah, I'll be right there. Just reading this article.
On what?
New bill Congress passed. Looks like it's going to affect the value of all retirement savings plans. My financial guy didn't tell me about this when I saw him the other day.
Well, my guy did, and we made a plan. You may have heard of him, Josh Jalinski.
Josh Jalinski is your guy?
Listen, if you're 10 years or less from retirement,
which I am,
Josh will give you a free economic plan, which includes retirement planning, a 27-point checklist to make sure your income lasts as long as you live. He'll even help you navigate the current tax code.
I'm definitely going to call Josh.
Cool, but first, can we play some golf?
Call Josh Jalinski, host of the popular Financial Quarterback radio program, for your free economic plan. 888-988-JOSH. 888-988-JOSH. 888-988-JOSH.
We're back. This is Josh Jalinski taking your calls all hour at 800-321-0710. If you have questions on stocks, bonds, annuities, mutual funds, whatever questions you have, no question is a dumb one except the one that you do not ask. We're going to give you some financial news of the week. IRS rectifies the mistaken interpretation of the 10-year payout rule. Now, sometimes we get into this stuff and it's meant to inform you, not to bore you. So this 10% rule, which is kind of interesting, a lot of people aren't aware of it. There was a 10-year rule that was passed, also called the death of the stretch. So the IRS was apparently interpreting the Secure Act's 10-year rule in a surprising way to require annual RMDs. So what does that mean? If you inherit $100,000 from your late mother, a non-spouse beneficiary, you have 10 years to spend down that money. According to some guidance, the IRS has made it clear, without actually saying so, that its prior interpretation was a mistake. So what they were saying is the retirement planning community thought the new rule would be you have to spend all of the money by the 10th year following the death when you inherit an IRA. So your IRAs are not tax-free investments. The one who gave it to you didn't pay taxes. I get some people that they don't realize that a 401k or IRA is a tax give me from the government. It's a gift or a loan. It's more of a loan from Uncle Sam, so that from 20 to 72, you can grow your money without paying any tax. It's kind of cool. People don't realize that. So if you don't have a lot saved for retirement and the accountant says, oh, you got to owe taxes this year, well, pop money in an IRA. It's better to pay yourself than Uncle Sam. So that was the idea behind it. But you're not avoiding taxes. You are legally deferring them. So big difference there. So a lot of people think, oh, it's a give me. And then they realize when they inherit these things from their aunts, uncles, parents, whoever, that they owe a massive tax bill. So the new rule so if you were inheriting a beneficiary, you had basically your whole life to drain that IRA. Then the new rule, most people said, well, you had by the 10th year. Then there was some confusing status that basically said you don't necessarily have your whole life. You have 10 years and you got to take an RMD every year for the 10 years. The Secure Act changed the payout rules for most non-spouse. So if it's your spouse, you don't have to worry about it. But if it's a non-spouse, like a parent, aunt, uncle, you got to worry about this. And if you died after January 1, 2019, those beneficiaries can no longer use the stretch IRA. Instead, they are subject to a 10-year payout rule, which requires the entire IRA to be paid out within 10 years of the owner's death. Most everyone thought, and this is from IRAhelp.com, Ed Slott's very great resource on IRAs. Most everyone thought that the annual RMDs would not be required under the 10-year rule. That's the way the IRS interpreted the 5-year payout rule, which applies when an IRA owner dies before their required beginning date without designating a beneficiary. Applying the 10-year rule the same way would give a beneficiary flexibility to take out any amount or no amount from the inherited IRAs year 1 through 9, as long as you have the whole thing emptied out in year 10. But in a revision dated March 25th, 2021, the IRS strongly hinted that it was treating the 10-year rule differently, and it created quite an uproar in the retirement planning community. It would require annual RMDs to be paid 1 through 9 and the remaining funds be paid out in year 10. Many commentators believe the IRS had simply made a mistake. And that turned out to be the case. In a subsequent revision dated May 13th, the service made clear that annual RMDs aren't required under the 10-year rule after all. So the 10-year rule is like the old 5. You can take out all your money in year 1, 2, 3, 4, 5. Well, what could be really cool is you wait till the 10th year, you get 9 years of tax-free growth. But let's say 1 year you lose your job or 1 year you don't have as much money. That would be a great year to take the distribution from a loved one because it's not tax-free. So the IRS may have cleared up that mess, but they may have created a new one. The IRS has said that the 5-year payout ends on December 31st of the year following the 5th anniversary of death. Most assume that the 10-year period would be applied the same way. Indeed, one of the most recent publications confirms that. That's publication 590B. You could go to irs.gov and check it out. But 2 paragraphs later, the IRS says that the ending date of the 10-year period is different when a beneficiary receiving stretch payments dies or when a minor child receiving stretch payments reaches the age of majority. That's really due to there's some rules if you're a minor child and you inherit it. And they'll probably release further clarification on that. That's confusing, and they usually do. So also there is a beneficiary planning loophole that has closed. With the passage of the Secure Act, once common IRA beneficiary planning strategies have been upended. For example, no longer can just anyone stretch payments of an inherited IRA. You must qualify as an EDB or an eligible designated beneficiary to stretch using your single life expectancy. EDBs include surviving spouses, minor children, and this is where I think once they reach the age of majority, they won't have that benefit, disabled and chronically ill individuals, and individuals not more than 10 years younger. So you get to still stretch the IRA. All other living, breathing IRA beneficiaries will now use the 10-year rule. There are no annual RMDs during the 10-year window, but the account must be emptied by the 10th year after death. So if you have questions on this RMD rule, we're going to talk more about it, break it down. But first, we're going to go to Ursula, who's calling us at 800-321-0710. Ursula, you're on with Josh Jalinski, the financial quarterback. Go ahead.
Thank you for taking my call. I just have a question. My husband and I bought an apartment, a condominium in Southampton about 48 years ago, and we bought it for $76,000 at the time. They are now selling between $1,000,001 to $1,000,003. And my question is this. My friend who also owns this same apartment wants to sell it below $1 million because she keeps telling me that there is a millionaire's tax. Can you answer that question?
Is that federally or state is she referring to?
Well, state. I live in New Jersey. The property is in New York. So
there is a mansion tax. The millionaire's tax in New Jersey does apply, but what could you get the value for? Too many people make avoiding taxes the goal when it should be to get the most you can.
I see. Yeah, I mean, I know I could roll it over in another property or, but I'm 84 years old. I don't want to do that. So I will have to pay the capital gains, whatever they are. I was told by my accountant to be as aggressive as I can be with write-offs, but of course I have to prove them. And I just then heard this, her telling me, sell it under $1 million so you don't have to pay a millionaire's tax.
Yeah, but what is the property worth if you sold it today? Is it worth $1.2 million, or is it like 1.03, or is it 1.05?
No, they're selling between 1.1 and 1.2 million.
Okay, so I would just sell it for what it's worth. And
okay.
I mean, I forget exactly what I got to look this up. There is a New Jersey mansion tax. I don't know if it applies. We have a lot of accountants who listen to the show. I'm not sure if it applies to properties you sell outside of the state of New Jersey.
I see. And
there is some type of mansion tax. I'm aware of what you're talking about. But, let's say it's 10%. Well, 10% of $200,000 is $20,000. So
right.
Why would you take a $1,000 pay cut on the sale? The other thing you could do is 1031 exchange it, or you could keep the property, and after you pass, it will be inherited with a step up in basis unless the Biden administration changes that.
I see. Yeah.
So I would also I would consult with an accountant and a financial advisor. So if you need help with any financial planning, call us right now at 888-988-JOSH, 888-988-JOSH, 888-988-5674, and get the free Income for Life Blueprint book when you schedule and keep your no obligation review. We'll be back after these messages.
Josh Jalinski, the financial quarterback here. In these uncertain financial times, it is imperative that you guard your financial future. If you call within the next 3 minutes, we will offer our complimentary bear market survival guide, which will detail steps to help your plan to potentially survive the COVID-19 crisis. The bear market survival guide will cover how you might still be able to retire amid a volatile economic climate. We will throw in our complimentary 27-point ultimate game plan for retirement. Call us at 888-988-JOSH, 888-988-5674 for your bear market survival guide.
Call Josh Jalinski, host of the popular financial quarterback radio program, 888-988-JOSH, 888-988-JOSH. It's always on your mind. Retirement, whether you're 55 or 35. Not everyone wants to work forever, and most would like a comfortable retirement. You may already have a plan, but is it the right one? Josh Jalinski, host of the popular financial quarterback radio program, is ready to guide you towards financial freedom. He challenges the ways your parents and grandparents saved money with fresh strategies, which are exactly what you need to navigate today's volatile economic climate. Josh's new book, Retirement Reality Check, is available to order on Amazon. It's an easy read that guides you through his system for securing your financial freedom, including tax-saving strategies, understanding the right investment mix, and more. Order now. Retirement Reality Check. Call Josh at 888-988-JOSH. Let Josh help you map out your retirement using fresh strategies. Call 888-988-5674. That's 888-988-5674.
Okay, we're back. And folks, call us 888-988-JOSH for the complimentary protection, savings, and growth review. So we'll give you our very own financial game board. Why is a game board so important? If there's one tip I could give you financially today, it would be get a financial game board. We have a game board that is a unique personal finance tool that I will give you a printout of your own customizable numbers. This isn't some one-size-fits-all program. This is built around you and the hierarchy of your personal economic household. Your financial life can be organized, it can be analyzed, it can be strategized, and your results can be tracked for optimal results. Think of it as the DNA for your personal financial wealth. The goal in its creation was to find a single tool that would avoid hype and opinion, but instead properly weigh and measure anyone's financial data and provide a course of action to achieve optimal results. With our model, you can identify and measure your present position. Too many people know, okay, what plan you got for me? No, most people don't even know what they have. And you'll never know where you're going until you start with your point of origin. So that's learning your protection. What insurances do you have? Savings vehicles, tax savings vehicles, growth vehicles, cash flow. Have you done a budget? How much do you spend on coffee? How much do you spend on fast food, going out to eat, all that stuff? And what do you want to spend your money on? Not just what you need, because most of us live our lives based on financial wants, but our financial plans are based on needs, which it's a really unfortunate term called needs analysis. And I don't know anybody who lives their life based on pure need. You don't need an iPhone. You maybe need a flip phone, but even that, people did fine without it. You don't need a new car. You don't need a vacation, but you may really want one. That may be a valuable part of your financial plan. So call us today and we'll show you how to visualize various financial strategies and coordinate all of your financial decisions so that your long-term results may create flexibility, wealth, income, and protection. So this is our very own model. Kind of looks something like this, what I'm holding up on our YouTube. And folks, if you're joining us on the radio, you can listen to us on WOR710.com or the YouTube. Go to youtube.com and search for The Financial Quarterback. We're live every Saturday and Sunday at 9, and we'll be answering your questions in the chat box. So if you have any questions on stocks, bonds, mutual funds, annuities, and Ursula's point brings up a good point, that sometimes because we talk about ways to minimize taxes in a legal way or take advantage of every available deduction, don't let the tax tail wag the dog. People are annoyed sometimes. They made 50 grand in profit and they got to pay capital gains. Well, you made money. So don't overthink that. Now you might say, well, I don't like to pay taxes. I don't have to. That's a different thing. So how could you strategize those gains? How could you mitigate taxes with retirement plans, with IRAs, with Roths, with solo 401ks? A lot of business owners, you're not doing a solo 401k. Maybe you're doing a SEP, and a SEP is limiting. So you got to look at what you can. So like, for example, with a SEP, you're limited to like 25% of what you make. So if you show 50 grand, you can only deduct 25% of that 50 grand. Whereas with a 401k or a solo 401k as an entrepreneur, you can write off up to 26 grand. So those are some little ways where retirement planning design helps. But so many times people worry about, I got a tax bill this year. Well, if you don't like that, consult with your financial advisor. See, are there more tax efficient ways to invest? There are. And call us at 888-988-JOSH for that. But sometimes people get annoyed, or they, like in the case of Ursula, why would you sell your house for $250,000 less to avoid whatever, a 5% tax? Now, the math may be significant in some cases where there's some of these states do have excise taxes that gets problematic, and that's where you want to talk to your accountant. But most people do not realize that you don't want to let the tax tail wag the dog. So you got to figure out what's important to you. And generally, there's 3 or 4 different objectives you could have. One would be capital preservation. Maybe you're really worried about the market. 2 would be tax mitigation. 3 would be growth. And sometimes those 3 goals are in conflict with each other. So maybe you have some money for tax efficiency, some money for preservation, and some money for growth. And typically people get into trouble when they kind of blur the lines and say, there's one product that does all. And there usually isn't. So there's no free lunch typically. So Yellen, Treasury Secretary Janet Yellen, says higher interest rates would be a plus for the U.S. and Fed. The Treasury Secretary said President Biden should push forward with his $4 trillion in spending plans, even if they trigger higher inflation that persists into next year. I don't know why that's a good thing. And higher interest rates. Higher inflation exacerbates the same income inequality that many people decry right now. If we ended up with a slightly higher interest rate environment, it would actually be a plus for society's point of view and the Fed's point of view. Now, I agree with that from a standpoint of we have to eventually allow rates to go up to normal, 3% for long term. A lot of our economy hedges on that without having the market sell off, 40% or 20%. But it doesn't seem like we're necessarily able to do that as a country. It seems like we've that cat's out of the bag. Now, plans savers are more aware of retirement income. So we'll talk about retirement income next, but we got to take a short break. So give us a call during the break, 888-988-JOSH, for your free book on a financial topic of your choice when you schedule and keep your no obligation review. And call us now and you get the Income for Life Blueprint at no charge when you schedule and keep your no obligation review. We'll be back after these messages.
Hey, meet you out on the first tee?
Yeah, I'll be right there. Just reading this article.
On what?
New bill Congress passed. Looks like it's going to affect the value of all retirement savings plans. My financial guy didn't tell me about this when I saw him the other day.
Well, my guy did, and we made a plan. You may have heard of him, Josh Jalinski.
Josh Jalinski is your guy?
Listen, if you're 10 years or less from retirement,
which I am,
Josh will give you a free economic plan, which includes retirement planning, a 27-point checklist to make sure your income lasts as long as you live. He'll even help you navigate the current tax code.
I'm definitely going to call Josh.
Cool, but first, can we play some golf?
Call Josh Jalinski, host of the popular Financial Quarterback radio program, for your free economic plan. 888-988-JOSH. 888-988-JOSH. 888-988-JOSH.
Folks, we're back. This is Josh Jalinski, the financial quarterback. And among retirement plan participants, what does that mean? Retirement plan, you do a 401k, you do a 403b. According to investmentnews.com, BlackRock did a survey. About 90% said they are interested in retirement income products and that having guaranteed income would be a plus. Workers and their employers are becoming more concerned about how to spend assets during retirement. Maybe that's you. Give us a call at 888-988-JOSH and we can give you a spending plan, not just a savings plan. Despite years of posturing by the retirement service industry and a handful of products designed to meet that need, retirement income is not the norm in DC plans, that defined contribution plans. And when plans do offer some way for participants to withdraw their assets, the most common options are through drawdown services or managed accounts or rollovers typically. The industry has been anticipating more demand for such products following the 2019 Secure Act, which sought to make 401ks more compatible with annuities. The pandemic might also have an effect on the perception of guaranteed income. According to BlackRock's survey, 68% of plan sponsors said that helping participants with retirement income was more important due to COVID. I guess people were taking withdrawals. The pandemic did not appear to affect the percentage of workers who feel on track with their retirement savings at 68%. So 68% of people surveyed felt they were on track, whatever that means. Do you feel you're on track? Give us a call. I'd love your feedback at 800-321-0710. Do you feel on track with your retirement income needs? But it did appear to hurt those who were already behind on savings. With 47, this kind of makes sense. Like if you're already saving a great deal in your retirement plan, you're kind of, hey, I'm doing well. I'm putting in 10% a year. But people who already felt they were behind, those who weren't saving, aren't doing as good of a job. With 47% of people saying the global event negatively impacted their retirement preparation. Wonder if that's you. Give us a call. 800-321-0710. I'd love to hear from you. Did COVID negatively affect your plans for retirement? Are you delaying retirement due to COVID? Then there's a Wall Street Journal article talking about bonds of all things. And in an era of, folks, just to avoid speculation in meme stocks, but we'll talk about inflation-protected bonds next hour. But first, give us a call, 888-988-JOSH, 888-988-JOSH, and we'll give you your very own blueprint for wealth. It's an assessment tool where you can see your whole life on one easy-to-understand sheet of paper. So give us a call now, 888-988-JOSH, 888-988-5674, 888-988-JOSH. We'll be back after these messages, 888-988-JOSH. And we're taking your calls all next hour at 800-321-0710. This is an interesting article by Wall Street Journal. Says buying I-bonds have developed conservative properties and tax advantages. And although there's no such thing as a free lunch, I-bonds can offer you some cost of living adjustments if you're worried about inflation. So avoid meme stocks and avoid strange cryptocurrencies. That's another tip. Folks, give us a call. 888-988-JOSH, 888-988-JOSH. Up next, we'll be talking about the bottom 90% of Americans are borrowing from the top 1%. Up next, this is Josh Jalinski.
WOR and WAXQ HD2 New York, an iHeart radio station. Available everywhere on our free iHeartRadio app. Number one for music, radio, and podcasts. All in one.
As our region recovers, we're here to tell the story. 710 WOR, the voice of New York.
An iHeart radio station.
66 degrees at 10 o'clock. Good morning. I'm Paul DeCastro. Early voting begins today in New York City's primary election, including the race to become mayor.
For the first time, residents will use the ranked choice voting system. Instead of voting for one candidate, they'll select up to 5 candidates in order of their preference. And in addition to the race for the mayoral nominations, New York City voters will also be picking from a number of candidates for borough president, city council, public advocate, and comptroller. Starting up this weekend, the early voting period continues through Tuesday, June 22nd, which is primary election day. If you want an absentee ballot, you got to get that request in by this Tuesday, June 15th. And of course, general election day is November 2nd. I'm James Flippin, WOR News.
Well, President Biden and the leaders of 6 other nations are vowing to take joint action against COVID-19 and all future outbreaks. The leaders made a commitment at the G7 summit in Great Britain Friday with a goal of ending the global outbreak next year. That includes international efforts to provide more than 1 billion additional vaccines starting this summer. Russian President Vladimir Putin is denying he was involved in killing his political opponents.
In an interview with NBC News, Putin says he's gotten used to attacks from all angles, and none of it surprises him. Both President Biden and former President Trump have called him a killer, but he calls that label, quote, Hollywood macho. Putin also rejected a report that Russia was going to give Iran an advanced satellite system that could help the Islamic Republic track military targets. He called it fake news, but noted they have military cooperation agreements with Iran. I'm Jim Forbes.
Putin and Biden scheduled to meet in Switzerland this coming Wednesday. A second arrest has been made in the killing of a 10-year-old boy in Queens. 26-year-old Ashram Rolakin faces weapons charges in connection with last Saturday's fatal shooting of Justin Wallace. The suspected gunman, Jovan Young, was charged with murder in the case earlier this week. He surrendered to authorities Tuesday night. In sports, the Mets beat the Padres 3-2, but superstar ace Jacob deGrom left the game with right flexor tendinitis. The 32-year-old previously missed about 2 weeks in May with tightness in his lower back and right side. The Yankees had a rare Friday off. They're in Philadelphia this afternoon.
Here's WOR Weather Channel forecast. Cloudy here for the afternoon. Southeasterly breezes. 70 are high today. Clouds for tonight, low 61. Partly cloudy to start Sunday, but clouds in the afternoon. We'll be on the watch for a shower or storm with a high 74. Monday, showers possible during the day, low 70s. Richard Wedding at the Weather Channel on 710 WOR.
Next news at 11. Start your day with Len Berman and Michael Rito in the morning, 6 till 10 weekdays. I'm Paul DeCastro on 710 WOR, an NBC News radio station.
Tired of losing money in the stock market roller coaster? Frustrated with the government taxing you into oblivion? Worried about inflation? How do you prepare for so many financial uncertainties? Welcome to the show that will help you develop your game plan. The Financial Quarterback with Josh Jalinski. Josh is a noted financial advisor and president of the Jalinski Advisory Group, and he's here to answer your questions. Call into the show at 800-321-0710. 800-321-0710. Now, let's kick off your financial future. Here's Josh Jalinski.
Okay, we're back. This is Josh Jalinski, the Financial Quarterback. And according to our beloved listener friend and realtor Robin, she writes, the New Jersey mansion tax, $990K pays $0. 1.1 million pays 11 grand. Yeah, but so that's my point. You know, if you're going to get 1.2 million and you got to pay, I don't know, whatever it ends up being, 11,000 or more, like, you know, just sell it for the greater amount. People sometimes get all preoccupied with that. So I get it. I mean, I think it's the difference. If you were selling between $999 and $1,005,000, yeah, that's, I think, where you then sell the house for $999 or something. Roger has a question that's on everybody's mind: how to properly spend down your IRA. Go ahead, Roger.
Yes, I was just curious about, because I had the IRA, and with this pandemic, I haven't spent anything. I know I have to take my RMD, and I had it scheduled for the end of the year. But I was just curious, what would be, I still buy stocks once in a while, but I don't know. Right now I'm in, daze here. I don't know what to do.
So wait, you got to spend down your IRA. How old are you?
I'm 75.
And how much money do you have in the IRA?
The IRA alone is 220, I think it is.
And what is your problem? Do you want to just take RMDs? Do you want to do Roths? Like, what are you thinking about?
Well, I was thinking of doing the RMDs, but I call the IRS on a Roth if I can change some of my IRA to a Roth, and they said no. They told me no, roughly.
No, you can always do a Roth conversion. You could convert the entire 220 grand. You would just need to be prepared for a big tax bill. So
that's the whole problem. Yes.
What's they're probably saying is when you have 220, you can't take the RMD and move it to Roth. You can take the money above the RMD and Roth that. So let's say you have 200 grand and your RMD is 10,000. You take the RMD that's 10,000, maybe you only Roth 10 or 20 grand this year, not the whole thing. Does that make sense? Now that means you would pay 20 to 30 grand in income taxes. You wouldn't pay 20 to 30 in income taxes. You would have 20 to 30 grand in new income. But depending on your tax bracket, it may be a good idea. Does that make sense?
Yeah, yes it does. Yeah, because just with my pension and my Social Security, I'm roughly, I think it was 70-something thousand.
So, yeah, if it's 70,000, and are you married, filing jointly?
Single. Okay. Divorced.
So it depends on your tax bracket. So if you show, and I'm not giving tax or legal advice, but if you look at the single tax brackets, single filers, from about 40 grand to about 85 grand, you're in the 22% bracket. approximately. I think it's up to 86 this year. I'm reading the 20 brackets that were just filed. So you could potentially Roth 16 grand and stay within the same tax bracket. So call us today, 888-988-JOSH, and we'll figure out if a Roth is right for you. Also, there might be other spending strategies. You may want to do a Roth. You may want to continue to defer taxes. Let nieces or nephews pay it. Forget you, paying it. But if you're worried about down the line, tax rates could be higher. You got to realize when you have an IRA, that RMD, you are not in control of the terms of that loan from Uncle Sam. Uncle is. And if you're paying 22% now, that might be a historically low rate for you. So you might want to tax diversify. Now, I'm not advising you go out and do anything without getting a consultation, which we offer for free at 888-988-JOSH. Okay, any other questions on that, Roger?
No, I thank you very much.
Thank you so much. Next up, we have Stephen, a good buddy of the program, calling us on our listener call-in line, which is 800-321-0710. And if you need a plan to spend down your IRA, call us at 888-988-JOSH. And I'll go into later, Ernesto, if you could remind me about potential ways to do an IRA spend down, that would be very helpful. So go ahead, Stephen. You're on.
Hey, Josh. I've got a question based on one of your comments just right before the top of the hour. What is the definition of chronically disabled as far as the IRS? A chronic disability as far as the IRS is concerned?
The definition of a chronic disability.
Yeah.
It would be, I think it would be the inability to perform duties of an occupation. And
well, if you're retired, are we talking about the six, daily living activities, or
no?
Or what?
They're talking about. I'm on the IRS website, and it says a person is permanently and totally disabled if both of the following applies. He or she can't engage in any substantial gainful activity because of a physical or mental condition.
Mm-hmm.
And a physician has determined that the ability has lasted or can be expected to last continually for at least a year or could lead to death. Now, that's from the Credit for the Elderly and Disabled.
Mm-hmm.
What I'm, and there's disability, but that's the definition of disability. So, but then there are people like if you're retired, it really wouldn't, it would be more for like a child if the question is for your IRA.
Yeah, talking about that, the IRA and actually the RMD part of the IRA.
Well, no. If you're over 72, you would have to take the RMD, regardless.
Yeah.
Then your wife would have to take it. The
right.
disability would say, let's say your child inherits it,
mm-hmm.
and they are disabled. Could be any number of disability issues that would trigger that. So a lot of people are disabled due to mental nervous issues. Some people are disabled due to other health issues, heart attack, stroke, cancer, whatever. Some people are disabled due to clinical depression. So if the heir is medically defined as disabled, then they would get to stretch the IRA,
mm-hmm.
which is pretty cool. That's a
right.
good provision in the new law that they kept that. So dumping
the stretch was
dumping the stretch was one of the worst middle class attacks in a generation, and people are just asleep at the wheel. We need to bring back the stretch. That was a great thing, but nobody's talking about bringing back the stretch except me. The death of the stretch was something that really hurt a lot of people, and they won't even know it. They won't even know the wealth that was lost and the potential. And by the way, that wasn't the government not getting revenue. The government was getting a perpetual annuity. I didn't even really care for stretches from the standpoint of the total tax that one would pay over a lifetime was actually greater because of the tax deferred compounding. And the IRA just kept getting bigger and bigger, so the government got a perpetual annuity. So I don't even know if the revenue estimates of ending the stretch are really accurate because they're not quantifying the lifetime value of that IRA for the government's coffers. Does that make sense?
It does, yes.
So, alas, though, I do not make public policy, but it's maybe someday.
There you go.
Maybe someday they'll talk to me.
Okay.
But, well, thank you, Steve. We always love to talk to you and your wonderful wife. So give us a call, 888-988-JOSH, if you want help navigating the new death of the stretch rule, which is pretty profound. Any other questions, Steve, before we go to our next callers at 800-321?
That'll do it, and thank you, and stay safe.
Thank you so much. 800-321-0710. If you have a question for me, 888-988-JOSH. We talked a lot first quarter of the hour about stretches and a spend down strategy. The next 30 seconds, I'll give you a spend down tip. It depends on who you want to leave the money to. Some people say Roth, and Roth is great, but what if you don't want to pay the taxes now? What if you're leaving money to a niece or nephew? Let them pay the tax. So you may want to keep everything deferred until an heir inherits it. So let's say our wonderful Ernesto, who's in the studio, he could leave all his money to his nieces and nephews. Let them pay the tax. Sometimes people worry about stuff. Then you do a Roth, then you got to pay this tax bill. But if you have kids, or if you love your nieces and nephews and don't want to see them have any extra burden, well, then maybe you do a Roth. But if you need the tax rate off today because you're getting slammed with taxes today, you do the IRA. So it's very simple. If you need the tax rate write-offs today, do the pre-tax stuff now. If you're like, well, I can afford to pay some tax now, but I'm really worried about future tax rates on the rise, that's where Roths come in. And when we return from the break, I'll give you some more tax-smart investing tips. When we return, this is Josh Jalinski, the financial quarterback, and call us right now for the free 45-minute Wealth Blueprint financial assessment tool. It is a great tool. You get to see your whole life on one sheet of paper. So let's say let's say you're married and your spouse isn't good with money. They'll be good with this. It's one easy to understand page. It's as simple as P, S, and G. And I'll talk to you about the P, S, and G assessment when we return. This is Josh Jalinski, the financial quarterback. Don't touch that dial.
Are you worried about the recent coronavirus crisis and how it may have affected your money? Hi, everybody. I'm Josh Jalinski, the financial quarterback, inviting you to join me for my complimentary 6 Ways to Keep Calm During Turbulent Markets webinar. If you schedule and keep your no-obligation webinar today at 888-988-JOSH. It's a great thing to do if you're stuck at home under stay-at-home orders. Call us right now, 888-988-JOSH. If you're bored, there's never been a better time to get a second opinion on your wealth than right now. 888-988-JOSH, 888-988-5674. And go to my website, retirementrealitycheck.com today and take your free investment profile quiz. And when you buy my book, you're eligible for 3 free gifts. 888-988-JOSH.
Call Josh Jalinski, host of the popular Financial Quarterback radio program, 888-988-JOSH.
Josh Jalinski, the financial quarterback here. In these uncertain financial times, it is imperative that you guard your financial future. If you call within the next 3 minutes, we will offer our complimentary Bear Market Survival Guide, which will detail steps to help your plan to potentially survive the COVID-19 crisis. The Bear Market Survival Guide will cover how you might still be able to retire amid a volatile economic climate. We will throw in our complimentary 27-point ultimate game plan for retirement. Call us at 888-988-JOSH, 888-988-5674 for your Bear Market Survival Guide.
Call Josh Jalinski, host of the popular Financial Quarterback radio program, 888-988-JOSH, 888-988-JOSH.
Jalinski, the Financial Quarterback, taking your calls at 800-321-0710. And some tax-smart investing tips that you may want to consider. Number one, look at Roths. Number two, look at pre-tax plans, qualified plans. If you're doing an IRA or 401k for your business and you need more write-offs, consider cash balance plans, defined pension plans where you can sock away more money on a tax-deferred basis for retirement and help your employees in the process. So number one, Roths. Number two, pre-tax things. Number three, you could also look at the QLAC, the Qualified Longevity Annuity contract. So let's say you don't like your RMDs and you want to defer them to 85, you can do that. Imagine not having to take an RMD on a certain portion of money. It's up to I think about $130,000 now you can put away in that. A lot of people don't do that because it doesn't really earn much, but the benefit is if you're worried about longevity risk and running out of money, let's say you're single and you don't want to put all your money in an annuity, but you want to put $100,000 just so if you live past 85, you get an income. That could be a real benefit. You could also look at something called investment-only variable annuities, and this will be growing with the rise of taxes on capital gains. So, for example, if you have $100,000 in a mutual fund, and the mutual fund throws off a taxable dividend of $5,000 for the year, that goes on your tax return. Now, the tax-deferred annuities were sort of in vogue when capital gains rates were higher, particularly in the 90s, I believe, under Clinton. They've kind of fallen on the wayside of people doing annuities for tax deferral because the beauty of owning stocks and bonds and mutual funds outside of an IRA is you could write off your winners against your losers. But if you have to pay 43.4% of every gain every year, that is going to significantly impede growth. So there are these things called investment only, basically fiduciary class variable annuities. There are no mortality and expense charges. There may be ones, but they're 0.2%. which is the cost of almost like a no-load fund, or $20 a month. And the beauty of that is there's no commissions, so you'd pay just a fiduciary fee to an advisor, like what we do at our fee-based fiduciary firm, Wealth Quarterback. And then if you have high-fee variable annuities, you can get them into these lower-fee programs, and you can still defer taxes. Now, you do have to pay tax on the growth, but then you're only paying taxes, one, when you need the money, and two, when you've made money. If you don't make money, you don't pay taxes. So what are some other tips? Also, buying ETFs or mutual funds that are tax advantaged or tax efficient, or stocks that don't pay a dividend. Like I always say, Warren Buffett, he buys dividend paying stocks, but he puts them in Berkshire, and Berkshire doesn't pay a dividend. Now, I own Berkshire Hathaway stock. I'm not recommending that anyone buy or sell it over the airwaves, but you got to be tax smart. There are a lot of stocks that don't pay a dividend. Now, that's another point that we as an investing public need to demand that stocks pay a dividend, because it used to be you could retire, and a lot of these big tech companies, they take that money, they don't pay a dividend, they grow their share, so they pay long-term capital gains instead of ordinary income. Which is why a lot of people are talking about raising capital gains tax, because they're not getting as much revenue as they used to. So if you want some tax smart ideas, call us at 888-988-JOSH, 888-988-5674. Next up, Angelo. You're on with Josh Jalinski, the Financial Quarterback. Go ahead.
Good morning, Josh. Me and my wife are going to be retiring together in about 3 years. I have a pension from my job, and I'm expecting Social Security, and she has a pension and a 401 also from her job, as well as Social Security. Is there a cap per year without getting taxed that we can collect as income, like also with the 401 for my wife's 401? Am I phrasing it correctly?
Are you looking to get more write-offs, or are you are you retired? Do you have any income?
No, I'm going to be retiring. Me and my wife are going to be retiring together in 3 years.
You and your wife are going to be retiring in 3 years. So the question is what? Do you want more write-offs, or are you worried about taxes on savings?
I want to be able to take out from my wife's 401. What's the most that we can take out from the 401 without getting taxed? Because we're also going to have the pensions from, because we filed taxes jointly together. So I have a pension, Social Security, and she has a pension, Social Security, plus the 401. So is there a cap that we can take out that 401 without getting taxed?
There are state income tax regimes where if you make over a certain amount, you aren't taxed.
In Florida. We're going to be retiring in Florida.
Well, there's no state income tax in Florida, which is a real problem for higher tax states like New York, New Jersey, Connecticut. They're losing revenue to people who are moving to Florida, Texas, Tennessee. My advice to New Jersey would be, if they cut state income tax to 3% or 4 or 5, most millionaires would say, you know what, I'm just going to stay. I'll have 2 houses. 3% isn't bad. What's the problem is you have like a 10.75% state income tax. And let's say you make $1 million a year, that 10% is $100,000 a year. You move to Florida, you just paid for your beach house with the tax savings. So you have to lower the state income tax so that it disincentivizes moving. Just like, you got to make it so the tax savings doesn't buy the beach house. So if it's 3% on $1 million, $30,000 a year, you could make a claim. Well, if that millionaire pays $30,000 to the state, $40,000, $50,000, it may not buy that beach house. It may buy, a ranch, but they might say, you know what, I really like my mansion in New Jersey, and I'm going to rent out a house in Florida for a month or two for $30,000, $40,000, and then I don't have to pay homeowners insurance. Then I don't have to pay property taxes in Florida. So you got to think like a business person. And that's how they think. But when they're like, man, I'm just an ATM and they're coming at me for more every single... I would even venture to say, if the state of New Jersey lowered state income tax to 5.75, we probably wouldn't lose that many people. It gets to where it's 10.7 that people go, I'm moving to Florida. They were even...
Yeah, I understand.
So it's quite onerous. So if you're saying, how can you avoid state income tax on 401ks? If you're moving to Florida, you don't pay any state income tax. Now,
so
if you're talking...
I can pull out a full amount on a 401?
No, this is where you're confusing it a little bit. You will pay federal income tax, and there is no respite for that. So if you pull $100,000 out of your 401k, you owe Uncle Sam, I would say, by the sound of it, you're going to be doing well with pensions and Social Security. You might owe 24 cents on every dollar of distribution, whatever your bracket is.
So whatever we'll pull out.
Do you know what your tax bracket is?
We're 24, I believe, right now.
So if you pull out $100,000, that 100, by the way, may cause you to go up another bracket. So your 24% may go in the 30s, depending on your tax situation. But you're that's the question. Yeah, you pull $100,000 out at a 24% bracket, you owe $24,000. You can't avoid that.
Okay.
Now you can mitigate that by doing a QLAC or Rothing strategically because you don't have an RMD doing a Roth. But the Roth is a taxable event. You might, by buying real estate, maybe you could get increased deductions. By redirecting money to your favorite church, shul, charity, you might be able to have that income not count against you if you're still charitably inclined. So we could give you our no obligation what to do with all my 401k and IRAs review. 45-minute strategy session with me. Call me right now, 888-988-JOSH. We have operators standing by to schedule your no obligation review. Any other questions on that?
No, that's all. Thank you, Mr. Josh, very much. Very informative.
Yeah, no, thank you for listening. Tell all your friends and call us at 888-988-JOSH for your free review. Next up, we have Bob, who is calling us. It's an open line hour, folks, so call us 800-321-0710 or go to youtube.com/thefinancialquarterback and type in the chat bar your questions. Go ahead, Bob.
Hi, Josh. Josh, I have a question with regard to long-term care payments for a home health care individual. The taxpayer has dementia and is living at home with his daughter. They're paying long-term care for someone to come in and take care of him. They've prepared Schedule H for the income tax purposes and prepared a W-2 form in showing wages and payroll taxes. My question is, the wages that they paid, are they able to deduct that somewhere on that tax return? And if yes, where? Would it be on Schedule C? Would you know that?
Yeah, there is topic 502. I'm not an accountant or tax advisor, but we could refer you to one who could help you with this. There is medical and expense. If you go to irs.gov, there's topic 502, which is the medical and dental expense category, and you may deduct only the amount of your total medical expenses that exceed 7.5% of income. So if all of those occur, so medical care expenses include, and I'm reading from the irs.gov, payments of fees to doctors, dentists, surgeons, chiropractors, psychiatric help, psychologists, non-traditional medical practitioners, payments for inpatient or residential nursing home care, if the availability of medical care. So there's a whole long list: weight loss, acupuncture, insurance, even payments for insurance premiums you paid for policies that cover medical care or qualified long-term care. So there's a lot of things like that. And then there's a whole, I want to say there's another Schedule 2, which impacts what you're talking about, that you could look at. So just go on the irs.gov website and search for it. And also you can call our office at 888-988-JOSH and we can put you in touch with an accountant. Okay?
Yeah, Josh, so it sounds like what you're telling me right now, and I'll check Section 502, is that these medical expenses that are on a W-2 form for the home health care nurse, that would go on the medical expense deduction if they qualify to exceeding 7.5% of adjusted gross income?
Yeah, it may. There is another thing that I may be leaving out. There's some schedule. I'd have to research it, but there's some other thing if you're deemed disabled that I'll have to look into for you. Okay, so give us a call, 888-988-JOSH. For a 45-minute free strategy session, I'll look into it for you, okay? So call us, folks, 888-988-JOSH during the break, and you'll get your free income for life blueprint. We'll go over cash flow. What are your hopes? What are your dreams? What do you want to spend money on in retirement? Maybe you want to take that trip to Italy. Talked to somebody the other day. It was great. She said she went on a sailboat trip. If you're listening, you know you are. You're a great listener, friend of the program. She went on a trip with her significant other on the Greek Isles, and it was like $1,200 for like a week or something. Food, lodging. Sounded very romantic. It was, imagine sailing all the Greek Isles or TD, and I didn't even know it was that much. And, when you wake up, she'd say you're in like a bay, and you jump out and go in the water. And you ever do that, Ernesto?
Well, it is sailing season, so I won't be on the Greek Isles, but I'll be on the Isle of Tom's River in Bayville.
Yeah, you were the first one who got me into sailing.
Yeah, we got to go this season.
I've only been once, but it was with you.
We got to go again. It's a great time.
So you know what, though? Your mom's in the Philippines. You could probably sail the Philippines. That would be cool. All the little islands.
You don't want me captaining that ship, though.
Yeah. So, but you need a good captain.
We have one.
But they had a sailing club, so everybody was involved. So, next up, we'll talk to Joe when we return from the break, who wants to know how will inflation affect his rental properties. When we return, we'll be talking about the ravages of inflation and how you could potentially protect yourself. And call us now during the break, 888-988-JOSH, 888-988-5674. We'll be back after these messages.
It's always on your mind. Retirement, whether you're 55 or 35. Not everyone wants to work forever, and most would like a comfortable retirement. You may already have a plan, but is it the right one? Josh Jalinski, host of the popular Financial Quarterback radio program, is ready to guide you towards financial freedom. He challenges the ways your parents and grandparents saved money with fresh strategies, which are exactly what you need to navigate today's volatile economic climate. Josh's new book, Retirement Reality Check, is available to order on Amazon. It's an easy read that guides you through his system for securing your financial freedom, including tax-saving strategies, understanding the right investment mix, and more. Order now. Retirement Reality Check. Call Josh at 888-988-JOSH. Let Josh help you map out your retirement using fresh strategies. Call 888-988-5674. That's 888-988-5674.
Okay, we're back. This is Josh Jalinski, the Financial Quarterback, coming to you live. 800-321-0710. If you have a question, we're getting a lot of good listener feedback. 888-988-JOSH. Those of you calling us for the financial game board. You might say I have a financial plan, but why do I need a game board? Well, what is your financial plan? Is it a bunch of numbers that don't make sense to you? Is it a future rate of return? Or is there more to that? What do we know? Life can change. Rates of return can change. Inflation rates can change. Tax rates can change. A game board helps you evaluate what you would do if the world changes. The world is ever changing. It's not static like a plan. A plan is static. So make it dynamic. Call us at 888-988-JOSH for the second opinion on your wealth. And we're going to go to Joe, who's a question on everybody's mind. Go ahead, Joe.
Yes, hi, Josh. Thanks for taking the call. I would rental properties, 2 and 3 family houses with no mortgages on them, and so now the question is, with inflation and trying to find investments that give me a reasonable rate of return, as I get older, am I smarter just to hold the properties and continue to rent them out, and they'll keep pace with basically inflation, or do I sell them and take that money and put it into investments? But it seems no matter what investment you put it into, like you say, nothing's static. Everything changes. They make something less tax efficient or less beneficial. And the next thing you know, you're not getting the rate of return that you could have got from your properties.
Yeah, well, number one, don't have the woulda, shoulda, coulda syndrome. A lot of people say, well, if I did this, well, we can't really go back in time, but we can look and say, what are you doing today? How do we make it more efficient? So let's first talk about rental real estate. Biggest problem I see in people who rent is they say real estate protects them from inflation, but then they do not raise their rents every year to keep pace with inflation. So question number one, on your properties, do you raise the rates every year by 3% or whatever the inflation rate is?
No, guilty.
So then real estate really isn't protecting you that much from inflation. So that's number one problem I see. People go, well, I have good tenants. I don't want to force them out. Well, that's fine. but we have to then honestly call it for what it is. Well, then the real estate is not inflation protected. It is a hard asset, which is great. You could like it. That gives you preferential tax treatment. Now, if you've held it for a long time, maybe you can't depreciate it as much. So when you evaluate real estate versus a stock, there are stocks called dividend aristocrats, and I'm not advising you to buy anything today, but those stocks have a history of not only sustaining their dividend. So think of it as like if you buy a stock, it's like a rental property, but they're growing those dividends every year. That's, I think, better than real estate where you're not growing your rents. They both have appreciation, but one might be a little bit more of a hedge against inflation. Still, I'm not anti-real estate here. I have a lot of clients who are real estate millionaires, and we help them if they want to keep it. But my thing is you need to have a model, an evaluative tool to say, what am I going to do this year? Yes, things do change every year, right? And sure. Sometimes, I'm guilty. Okay, I didn't take advantage of that tax break last year because I was too busy. Well, we're not too busy for our clients. So we're going to work with you so that you could take advantage of everything you could take advantage of this year. Yes, we know things get worse in the future. You can't look back in the past. You can't look to the future too much. You got to live in the moment and focus on the present, because there are present tax laws and there are things you can take advantage of today. But it's interesting you answer that question. Thank you for answering it honestly. Most real estate people aren't honest with themselves about the inflation benefits, and then they're not. Now, I'm not telling you to go raise your rents on all your rental property. I'm just saying that's why real estate can be a good inflation hedge. It's
just so tough if you have the real estate, at least in New York. It's so difficult if you get a tenant that becomes a non-payer. That's what I try to do is always rent to people who are on Social Security so that they can't come to me and say, well, I lost my job or things changed. Well, no, Social Security never changed. So you always get, you get a tenant that's like that, they consistently pay. But as they get older, it's very difficult too, because they're very difficult to get out as they get older, and and their family starts coming over and staying, and then they think they're going to be grandfathered into their aunt's apartment, and it becomes very difficult. So, maybe, it's a tough one.
I mean, even a 1.5% increase every year might help, but realize that if we're in a real estate seller's market, so you could always cash out now while you're winning. If you don't need those, keep the cash liquid for the next, crash. There will always be downturns, if not crashes.
Right.
And the one who holds the cash sometimes holds the future. But, then you might be missing out on income and tax benefits. So when real estate is evaluated, you have to look at inflation increasing income, tax efficiencies, selling on the top. So there's a lot that we could help you with. And it might be diversifying too. It might be you have some real estate properties and you have some stock, some ETFs. Typically, those who are attracted to real estate are attracted to it because they can see it, so they feel more comfortable with it. The other thing I've noticed too is a lot of real estate people don't really look at their numbers, and they might just do better in the market in a low-cost fund or something than in their real estate from a capital appreciation perspective. So I hope that helps you. Oh, go ahead.
I do appreciate that. I was just going to say, you can only have so much in the market. You can only have so much in annuities. So I thought I was diversifying to some extent. So that's why I kept the real estate, holdings, because I figured, enough in the stock market and enough in an annuity. So I said I'll keep the real estate. Then I kind of have like a trident, a fork of different ways to come at life. But
I love diversification. I like real estate, but let's evaluate the real estate to make sure it fits your plan and make sure you cash out at the right time. Also, there's no saying you're not going to go back into real estate. It's just evaluating what the rate of return is. So one of the things we do is we break out a financial calculator, and if you bought the property at, in the 90s for X and today it's worth Y, what was your rate of return on just capital appreciation? So here's the thing. If you're getting no inflation, and let's say your rate of return is like 3 or 4%, and then you have all the risk of the tenants, well, then it may or may not be the best place for capital. Now, you might really be getting good tax benefits. I don't know. We'd have to look into that too. So you would want to equate that because you could get depreciation. That's one of the benefits of real estate, that they may be changing soon. So like you said, it's ever changing. That's why I have a job. That's why it's a good profession to be in. So call us at 888-988-JOSH, and we will help you through the ever-changing world of financial planning, investing, insurance, stocks, real estate, annuities, whatever you want to evaluate. We have an evaluative financial game board where it's like playing chess. Okay, move the rook here. Do I do this? But you're not going to place it. You're going to visualize it on the game board before you actually do it. So we'll help you. 888-988-JOSH, 888-988-5674. We'll be back after these messages.
Hey, meet you out on the first tee?
Yeah, I'll be right there. Just reading this article.
On what?
New bill Congress passed. Looks like it's going to affect the value of all retirement savings plans. My financial guy didn't tell me about this when I saw him the other day.
Well, my guy did, and we made a plan. You may have heard of him, Josh Jalinski.
Josh Jalinski is your guy?
Listen, if you're 10 years or less from retirement,
which I am,
Josh will give you a free economic plan, which includes retirement planning, a 27-point checklist to make sure your income lasts as long as you live. He'll even help you navigate the current tax code.
I'm definitely going to call Josh.
Cool, but first, can we play some golf?
Call Josh Jalinski, host of the popular Financial Quarterback radio program, for your free economic plan. 888-988-JOSH. 888-988-JOSH. 888-988-JOSH.
Are you worried about the recent coronavirus crisis and how it may have affected your money? Hi, everybody. I'm Josh Jalinski, the financial quarterback, inviting you to join me for my complimentary 6 Ways to Keep Calm During Turbulent Markets webinar. If you schedule and keep your no-obligation webinar today at 888-988-JOSH. It's a great thing to do if you're stuck at home under stay-at-home orders. Call us right now, 888-988-JOSH. If you're bored, there's never been a better time to get a second opinion on your wealth than right now. 888-988-JOSH, 888-988-5674. And go to my website, retirementrealitycheck.com today and take your free investment profile quiz. And when you buy my book, you're eligible for 3 free gifts. 888-988-JOSH.
Call Josh Jalinski, host of the popular Financial Quarterback radio program. 888-988-JOSH.
Okay, we're back. This is Josh Jalinski. If you miss a show, download the show on podcasts on your Apple, iPhone, Android phone, and give us a call, 800-321-0710, 800-321-0710, 800-321-0710 if you have a financial question for us. And there's a lot of financial topics talking about. But next we're talking about Roth conversions may not pay off until age 90 for most. That's interesting from Investment News. They're basically saying, I don't know if that's true, but I guess they're alluding to the fact that when you have a Roth conversion, you are choosing to pay tax now to avoid taxes later. So you need to affect Roth, factor in lost opportunity cost. I don't really know if they're doing it properly, to be honest, when I'm looking at this. But as I'm looking at this article, interesting article on Roths by Emil Halez, tax rate changes have minimal benefit on Roth Conversions. Edward McQuarrie, professor emeritus at Santa Clara University, wrote in a recent paper, the most important factor is actually compounding. Roth conversions almost always work out in a client's favor, but not necessarily for the reasons that advisors often recommend them, according to a new academic study published this week. Contrary to conventional wisdom, tax rate changes, up, down, or flat, have a minimal effect on the long-term benefits from converting a traditional IRA to a Roth, says Edward McQuarrie, professor emeritus at Santa Clara University. Instead, the overarching factor that gives Roths an edge over time is compounding, tax-free compounding. In his study, he examined the reasons driving recommendations of Roth conversions, particularly several big changes to the law that now affect those decisions, such as the increase in the required minimum distribution age to 72 and the demises of the stretch IRA strategy and the recharacterization provision. If you recommend that people make small prepayments of their mortgage so that over decades they have tens of thousands of dollars in interest saved, then Roth conversions would probably also make sense for thrifty clients on the same horizon. He found that tax rates don't need to be higher for Roth conversion to be beneficial. Basically, the old logic was you're Roth converting because if you have 100 grand and you Roth convert, you owe 30 grand. And then it grows and grows and grows to 700,000 tax-free. Whereas you have that same 100 and grows and it's $1 million taxable. If you're at a 30% tax bracket, state and federal, there really is no difference between an IRA and a Roth, assuming tax rates stay the same. But if tax rates go up by you paying taxes now, that's one benefit of the Roth. But he's saying there's another benefit here. He found that tax rates don't even need to be higher for a Roth conversion to be beneficial, and that the practice of using funds outside of the account to pay the tax on a conversion doesn't make much difference. I would argue it does, because a lot of people right now have money in cash earning zero. So if you could take that outside money that was doing nothing and then it allows this other money to grow tax-free, I think it is powerful. Roth conversions can almost be as beneficial for middle-class earners as those in the top bracket, his report concluded. Only in the unlikely scenario that someone is the 0% tax bracket is it justifiable to recommend a conversion based on higher tax rates in the future, McQuarrie noted. And unless a couple's peak wage earnings are above 200 grand, or for some reason they haven't saved much for retirement, they will most likely be in a low bracket when taking out RMDs, according to the study. Unless both members of a 60-something couple are 401k millionaires, their tax rate in retirement will likely be 12%, McQuarrie wrote in the paper. They will have last seen tax rates that low when they were students. In most cases, the benefits from a Roth conversion, but not the people listening to this show. I can news you, that guy with the pension and the Social Security, guy's making like 150, 200 grand a year in retirement just on pension, Social Security, guys in 24% bracket. That might be a big difference as well. That's why everyone's numbers are different. So you have to run the numbers for yourself. You don't want to just do something because somebody says it on the radio, me included. You want to get a financial review, 888-988-JOSH, to do so. The success of a Roth conversion, he writes, is guaranteed, not my words, his, by the mathematics of compounding. Assets in a totally tax-free structure compound faster than those same assets in an account subject to even the most minimal tax drag. It may take decades to recover, but given decades, faster compounding always overcomes the initial tax debit. Now, according to his research, so he's very big into Roths. Therefore, the questions advisors should ask when deciding to recommend a Roth conversion are whether the client is on track to build surplus assets in their tax-deferred account, meaning, are you going to become a 401k millionaire? and whether they are okay with not seeing a benefit until age 90 or later, the report noted. And tongue-in-cheek, another question that would provide an obvious recommendation for a Roth is whether a client's living expenses can be covered while they are in the 0% tax bracket. Which means, okay, you can be in the 0 bracket having these Roths, but if you have other monies and you need money to live, and then you got monies in IRA and you're taking money out and you're paying taxes and then 24%, here's the thing. You should not take carte blanche information, do a Roth, do an IRA. You should do your homework. That's simple. And Macquarie also said if a client answered no to all these questions, other options could be considered, such as a backdoor Roth or life insurance products. And it's interesting because I've been saying something like this with, if you have people, they're worried about Roth or IRA, just save. Get the deduction, because you got to be like a millionaire. You got to have $1 million in your 401k for that money to be like a real problem under current law. Now, the idea is that I think we're going to have tax creep. It's like I talked about with Jeff Schnepper later, and I'll talk about that. What is tax creep and how it can affect you? Up next, this is Josh Jalinski, the financial quarterback. Call me right now for the no obligation financial game board review, and you'll get the free Income for Life blueprint when you schedule your no obligation review right now at 888-988-JOSH. 888-988-JOSH. We'll be back after these messages.
It's always on your mind. Retirement, whether you're 55 or 35. Not everyone wants to work forever, and most would like a comfortable retirement. You may already have a plan, but is it the right one? Josh Jalinski, host of the popular Financial Quarterback radio program, is ready to guide you towards financial freedom. He challenges the ways your parents and grandparents saved money with fresh strategies, which are exactly what you need to navigate today's volatile economic climate. Josh's new book, Retirement Reality Check, is available to order on Amazon. It's an easy read that guides you through his system for securing your financial freedom, including tax-saving strategies, understanding the right investment mix, and more. Order now. Retirement Reality Check. Call Josh at 888-988-JOSH. Let Josh help you map out your retirement using fresh strategies. Call 888-988-5674. That's 888-988-5674.
Okay, we're back. This is Josh Jalinski, the financial quarterback. Give us a call at 888-988-JOSH if you want the no obligation financial second opinion on your wealth. And this guy who wrote this Roth conversion said there is no benefit to a Roth conversion for the sake of tax diversification. I think that's hogwash, but I like to point divergent viewpoints. Here's the thing. Do you believe that tax rates are going to be higher in the future? Then why wouldn't you, if you're in a 24% bracket, and this guy says the average retiree is in a 12% bracket, this is why you always look, I'd like to have this guy on the show maybe, you always look at the fact pattern in front of you. So let's say, Ernesto, you're single, filing taxpayer. You might be in a 24% bracket when you have a good income year, maybe 32, whatever. When you have a less income year, you might be in 12. So when you're in the 24% bracket years, you do the IRA. When you're in the 12% years, you do the Roth. There is a benefit of tax diversification. I think what I think he's doing is mathematically computing current rates, which are fairly low historically, which that's not really true because you can't really write off anything anymore. So when you hear people say that, that's not altogether that true. Some ways we're paying more in tax than we ever paid before. But he's referring to really the federal rates. So if you have money in $100,000 in an IRA and you take $100,000 out and you're in the 12% bracket, well, you wouldn't be in the 12% bracket. You'd be in about the 24% bracket. That's $24,000 that goes to the government. If you had that in a Roth, you pay nothing. Now you paid the tax up front, so you lost the benefits of compounding, which I think is what he's doing to get that benefit. He's probably calculating some type of lost opportunity cost. But even his research says you got to wait till 90. So let's say you live to your 80 and you have 2 kids. You can pass even with the stretch, 10 years of tax-free compounding. So I think it's a still beneficial thing. So imposition of RMDs, excise tax on undistributed balances, stacking rules, and other devices can be used to extract revenue from holders of large Roth accounts. Roth accounts cannot provide tax diversification. Nothing can. Well, I fundamentally disagree with that, but it's good to talk about what you disagree with too. To get the point across, there is no one size fits all. But if you believe tax rates will be higher, as I do, think about tax creep, right? We had this net investment income care tax, known as the Obamacare tax. President Trump came in. They never got rid of that. That's the 3.8% tax. And President Biden's coming in. They're never going to get rid of that. That's tax creep. They're going to add these taxes here and there, everywhere. I believe in tax diversification. And not only that, it's what you leave to your heirs, tax-free, that matters as well. So call us 888-988-JOSH if you want the legacy income review. 888-988-JOSH. There is no one-size-fits-all answer. Call us 888-988-JOSH.
The preceding program was sponsored by the Jalinski Advisory Group. Any awards, rankings, or recognition by unaffiliated third parties or publications, including 5-Star Wealth Manager, Advisory of the Year finalist by Senior Market Advisor, and top of the $1 Million Roundtable, are in no way indicative of the advisor's future performance or any individual client's investment success. No award, ranking, or recognition should be construed as a current or past endorsement of Josh Jalinski or Wealth Quarterback LLC. Information regarding specific awards, rankings, or recognitions is available on the Wealth Quarterback website at www.jalinski.org. All investment strategies have the potential for profit or loss. Investment strategies such as asset allocation, diversification, or rebalancing do not assure or guarantee better performance and cannot eliminate the risk of investment losses. There are no guarantees that a portfolio employing these or any other strategy will outperform a portfolio that does not engage in such strategies. This broadcast should not be construed by any client or prospective client as a solicitation to effect or attempt to effect transactions in securities or the rendering of personalized investment advice. Due to various factors, including changing market conditions, the information discussed in this broadcast may no longer be reflective of current positions or recommendations. While information presented is believed to be factual and